Hi everyone, this is Keith Sprauer, Chief Investment Officer of Global Wealth Advisors with the fourth quarter of 2023 Outlook. As we move through the third quarter and are now looking out through the end of the year, we are really seeing just how complicated the world has become. As we discussed a few quarters ago, we continue to live in a VUCA world, a world that is volatile, uncertain, complex, and ambiguous. Large-scale wars in Ukraine and the Gaza Strip, military coups in Africa, and significant divisiveness here in the U.S. keeps economists and market strategists guessing on the direction of the markets and the global economy. Here we are showing the familiar performance quilt, which includes the year-to-date data, which are for the first 3 quarters of 2023. This is shown in the far right column. The performance numbers are holding in even though we've had a tough third quarter across asset classes. You can see equities are doing pretty well, and it's not until you get to the fixed income markets do you see any negative performance. And this is based on the volatility that we've seen in the fixed income markets, given the back and forth we have seen with the Federal Reserve and inflation, which I will cover in a few minutes. Most of our clients have diversified multi-asset allocations, so I do like to point out how diversified they are by looking at the 60-40 allocation and how that has performed. As you can see, the white box titled asset allocation is still positive for the year, even with the allocation to poorer performing fixed income asset classes. The drivers of the markets haven't shifted too much though. The biggest factor in the US and abroad is still inflation and its anticipated effects on the economy and on global central banks. Here in the U.S., at the Fed meeting in September, the members plotted their future Fed funds end year targets. As you can see, as we move through 2023 and into 2024 and beyond, the rates become lower and the individual dots become more disparate. Across the top is the median rate, which is just the middle data point when the different dots are ranked from low to high. If we focus on 2025, the year-end rate projections are as high as 5 3/4 and as low as 2 3/4. This doesn't tell us much as individual points, but when taken in conjunction with the other points plotted, the rate is trending lower and the median number comes down substantially from 2024 to 2025, pricing in somewhere between 100 and 125 basis points of cuts for 2025. My view is that the economy stays firm for the rest of the year, softens in 2024, and inflation continues to drift lower. I feel at that point the Fed will need to cut more than is built in for next year, which is currently a rate cut of 50 basis points or 0.5% by the end of 2024. This is what the Federal Reserve is telling us. Let's look at what the market has built in for the rest of this year. I put together this slide that projects where the markets expect the Fed funds rate to be by the end of the year or through the December 13th Fed meeting. At the time this was put together on October 5th, the market was saying that there is a 67% chance that the Fed does nothing for the rest of the year and a 29% chance that they hike by 25 basis points. These numbers are always changing as new economic data comes out or as members of the Federal Reserve make speeches, but keep in mind from the previous slide that the Fed felt they would hike 50 basis points before year end. I believe that they're done hiking for this cycle with rates remaining high, mixed economic data, and geopolitical concerns, and the fact that inflation has come down over the past year. I think they'll stay at the current rate of 5 1/4 to 5 1/2 through the first half of next year. As mentioned, one of the items that is a concern is the current level of interest rates. We have seen rates spike up and settle in at higher levels. It makes sense to walk through why this is the case and what it may mean for the economy over the next 3 to 6 months. Stated simplistically, interest rates are driven largely by Fed action, and they influence the shorter dated maturities, and inflation expectations influencing longer dated maturities. And as you can imagine, these two factors are interconnected. Though we have seen headline inflation come down substantially from over 9% to under 4%, it has rebounded some due to issues in the energy market and continued labor strength. And we see this in the Consumer Price Index graph on the left. Interest rates have stayed elevated for a few reasons: economic resiliency, sticky inflation, uncertainty of continued Fed hikes, the Fed rolling their balance sheet off, which means letting treasuries mature without going into the market to buy more, and expected higher U.S. Treasury supply due to the capital used to fund the war in Ukraine and reduce buyer base from foreign governments. And these are just a few variables keeping rates at their recent highs. What's keeping inflation where it is and where we may be going can be broken down into a few larger categories. One would be what's keeping it hot, and the other is what's cooling it down. On the point of keeping inflation elevated, the labor market is one of those items. Looking at the graph on the left, we are seeing non-farm payrolls have an unexpected increase. The data released for September was expected to show 160,000 in new payrolls, but it came in at a much stronger number at 336,000. To get to an economic sweet spot, we need those numbers to consistently come in below 200,000 a month. We also need the increase we've seen in wages to decline from the 5.7% year-over-year number to somewhere below 4% wage growth on a year-over-year basis. Another big contributor to inflation is energy prices, gauged here by crude oil prices. This graphic is showing the move we've seen in West Texas Intermediate crude for 2023. We have seen a big move since July. A lot of this has to do with the global conflicts we have seen, and even though the U.S. remains a net exporter of oil, our supplies have become low. Effects on inflation won't increase the number too much as long as the prices stay below $90 a barrel. On the good news side, or what may be cooling or bringing down inflation, is the shelter component. We have spoken in the past about how much of a lag there is in some of the housing data, and here we're looking at new tenants' rent, which is the darker line tagged to the left-hand side of the graph. And you can see the recent drop from rent increases of up to 12% to dropping back down to no change. The light blue line, which is matched to the right-hand side of the graph, is just starting to turn down given its 9-month lag. What this all means is that this component of CPI will be coming down substantially in the months to come, helping bringing the overall inflation number down. I would say that the economy is robust, but it has been resilient. GDP is coming in well above recessionary type numbers. GDP for the first 2 quarters of this year were above 2%, with an expectation of GDP for 2023 of about 2.5%, with consensus for 2024 thought to be at about 1%, which is why when you hear people speak about recession, they've pushed it off to some point in 2024 or believe that a soft landing with no or a mild recession happening. We know that 2/3 of GDP is consumer spending, so continuing to look at any stresses that may affect that spending is important. Here we're looking at 2 pieces of information that can really affect the consumer over time. The first is credit card rates. They've drifted up to well over 20%, and as families have drawn down savings to keep their current lifestyle in the face of inflated prices, credit cards are being used more, and as we have seen, credit card delinquencies are on the rise. The other item here that doesn't affect everyone is where mortgage rates are currently. This graphic shows that a 30-year fixed rate mortgage is currently about 7.5%. When you look at mortgage rates historically, this number isn't too far above the long-term averages, but you can see how quickly the increase has come since January of 22, and this is after a very long period of low mortgage rates. So what you get is higher monthly payments and a down payment on a house where prices have been, until very recently, very fully valued. I put this bank balance sheet slide in to show the difference between the largest banks and other banks. And I think it's important to not forget what happened in March in Silicon Valley Bank or First Republic, with Signature Bank and others. And although I don't expect a banking collapse, a lot of the same variables are still in place. For investors, certain areas of the commercial real estate market are attractive, but for banks, many commercial real estate loans in these areas, particularly like office space, are still struggling and putting pressure on bank balance sheets. You can see here that for smaller banks, it's averaging 44% of their loan lease book. And although it's a positive arbitrage for banks to take in deposits and pay very little, and use some of that money to create mortgages that are paying them 7.5%, as we saw earlier, the bottom right chart is showing us that small bank deposits are not growing because investors can get over 5% on money market funds, where many banks are still paying less than 0.25% on deposits. Another big driver of recessionary and market talk is corporate earnings. Earnings have been good this year, and the average estimated earnings, which are in the blue bars on the left-hand chart, are expected to see continued growth. One of the things that is continuing to happen, though, shown in the box on the graphic on the right, is that earnings growth is currently coming more from cutting expenses, which is reflected in that margin number, and not from revenue growth. I'd rather see growth coming from the revenue side, but cutting costs and right-sizing a company is also important to the bottom line and to moving forward. I usually don't spend a lot of time on currency, but I want to turn our attention to the dollar for a few minutes. We have seen this many times in the past, where people will declare that the dollar is dead or moving in that direction. But I do think there are longer-term trends that are starting to develop. The table on this slide is very interesting. It takes the last 10-year period and gauges how other currencies have fared versus the dollar over this period. So it shows the percentage change versus the dollar. The blue highlights are countries that are part of the G20. As you can see, the dollar has been strong versus other currencies. It will always ebb and flow, but I think as a secular trend, we may be very close to a 40-year high in the dollar. I bring all of this up because there seems to be a true change in the air. As you all know, there is quite a bit going on in the geopolitical arena and with global economies. We are seeing emergent market economies start to push back hard on having the US dollar as the global reserve currency. Much of this has surfaced around the war in Ukraine and forced governmental change in some African countries where sanctions are being placed. These countries and others that have continual sanctions placed on them are pushing back. As you may know, sanctions can shut down the global money transfer system, which is in dollars, preventing these countries from transacting trade freely. I think this is where the longer-term change is coming. Until now, the financial system has been the most powerful global driver, and this area has been historically commanded by the US and Europe. But the BRICS countries, or the new BRICS plus 6 countries, are very rich in the areas of food and fuel, and as an aside, nuclear capabilities. And given what we saw during COVID with supply chain issues and similar issues internationally, given the war in Ukraine, they are really starting to wake up to the fact that if they work together, they have a great deal of power. So what we are seeing in these countries is them working towards putting their own money transfer system in place and coming up with either their own new currency or using a currency that's already in place, like the Chinese currency, for example. And lastly, they're moving out of the US dollar by selling off their treasury holdings. And all of these things would weaken the dollar. But how does that translate into investment themes? It means that over time, we may want to allocate more than we currently are outside of the US. This is a surprising graph to a lot of people. In the past 12 months, as of October 5th, it's showing the international equity markets doing better than the S&P 500 by more than 2.5%. And when you look at some of the detail around these markets, the PE ratios are much lower than the S&P 500, and we may see some European softness being built into the market, giving everything going on in that part of the world, which would help valuations versus US equities. So let's take a minute and look at valuations. This graph is a little different than other valuation graphs I've used. The same information in general, but this uses statistical z-scores to help. An easy way to look at this is if the zero line is the average, below that line is historically cheap, and above that line is rich. The number at the data points are the standard deviations away from the average. If you focus on where we are currently, which are the circles, you can see that the asset classes get more expensive as you move to the right. You can see that with the weakness we saw in the markets in the third quarter, it helped valuations continue to be at fair to cheap levels for almost all asset classes. U.S. equity on the growth side and high yield markets are a bit more overvalued than the other asset classes, but there's still value to be had. I want to finish out with some of the influences on the economy and the markets by looking at some headwinds and tailwinds. Starting with the headwinds. Some we've previously seen are still in place, though I do feel that some of these will be resolved over the next few quarters. But how long rates are higher and how much geopolitical volatility we see are still a bit of a question mark. On the tailwind side, valuations are fair, as we mentioned. I put rolling recession in as a tailwind because the fact that recessionary forces are affecting different industries at different times, which is a general definition of rolling recession, it's better than having a recession all at once, meaning hitting every industry at the same time. I also put a new category in there called settling in. And this is a term I'm starting to use to express the fact that people could get used to things and start working through them, whether that's getting used to higher rates or geopolitical volatility. And these items stay with us for longer. People will begin to change their habits and may still be strong consumers. We've seen this historically at times where there have been very high interest rates, oil embargoes, the Federal Reserve hiking aggressively to stomp out inflation. And this isn't anything we haven't seen before in one form or another. And eventually markets and economies get back to equilibrium. As I have spoken about many times before, it's difficult to manage assets to long-term variables like demographics, currency changes, geopolitical strife, but we do have to keep them in mind as we make adjustments to the portfolios, and we will. From everyone here at GWA, thanks for watching, and I'll speak with you next quarter.